I want you to close your eyes for a second and just, imagine the year 1851.
Okay, 1851. That is well before the American Civil War even started, right?
Exactly. We are talking over a decade before the Civil War. Millard Fillmore is the President of the United States.
Wow. Millard Fillmore, that's going way back.
Right. And the commercial telegraph at that point is brand new. It's bleeding edge technology.
Like the absolute frontier of communication.
Yeah, and the Pony Express is still, it's a few years away from even being founded. So imagine a company born in that exact year, built entirely on telegraph wires, Morse code operators, and, physical cash offices spread across this dusty frontier.
Okay, I've got the picture. Very Wild West.
Right. Now, open your eyes and fast forward to today. That exact same company is casually jumping on an earnings call with Wall Street analysts to discuss the rollout of a native US dollar-backed crypto stablecoin.
Just wild.
And they're talking about the integration of global blockchain networks and this aggressive deployment of artificial intelligence to automate their massive back office. It genuinely sounds like science fiction.
It really does. It sounds like a case study from a business school, right? Where a professor asked students to come up with the most extreme corporate pivot imaginable.
The ultimate stress test.
Yeah. The cognitive dissonance is just staggering when you put that founding date next to their current technology stack. But, we are talking about Western Union here.
Right. The company that probably comes to mind immediately when you think of, sending cash to a relative overseas.
Right.
Or wiring money in an emergency.
Exactly. The old reliable yellow and black sign.
Yeah. And our mission on this deep dive is to really unpack the Western Union Q1 2026 earnings call transcript.
Yeah.
Because there's so much to get into.
Oh, there's a ton.
We're going to look at how a 175-year-old legacy giant is navigating what is, frankly, an incredibly complex global maze right now.
Yeah, and it's not just one issue they're facing.
No, not at all. We are talking about geopolitical shocks in the Middle East, shifting U.S. immigration policies impacting the southern border.
Right.
And then on top of all that, the absolute frontier of digital assets and Web3 infrastructure.
And what makes this transcript so compelling to dissect is the core tension that's driving their entire strategy right now.
The balancing act.
Yes, exactly. Western Union is currently attempting to pull off, probably one of the most difficult maneuvers in modern enterprise.
It is.
They are trying to perfectly balance the rapid modernization of their business. So, launching digital wallets, scaling a crypto platform, integrating large language models with the meticulous ongoing management of their massive legacy physical cash network.
Which they still rely on heavily.
Oh, absolutely. And they have to execute this whole transformation while simultaneously keeping Wall Street analysts and shareholders satisfied with their quarter-to-quarter profit margins.
Which is no small feat. It's less like upgrading your computer's software and more like, trying to lay high-speed fiber optic cable across the country while you are still legally obligated to deliver thousands of messages a day by horseback.
That is a great analogy. Yeah.
The infrastructure of the past has to fund the infrastructure of the future.
Right. And neither one can be allowed to fail.
Exactly. But based on the numbers from this first quarter of 2026, the transition is proving incredibly volatile. So we should probably start by unpacking the top-line numbers and what management delicately referred to as a margin dislocation.
Yes, the infamous dislocation. Let's look at the actual Q1 scorecard. So Western Union reported $1 billion in revenue for the quarter.
Okay, $1 billion.
Right. Now, on an adjusted basis, that represents a 1% decline year over year.
A decline. Which never sounds good on an earnings call.
It doesn't. In isolation, a decline looks concerning, but context completely shifts the narrative here. Because that negative 1% actually represents a vital 400 basis point improvement from the fourth quarter of 2025.
Wait, so they were down even more before?
Much more. The trajectory is sharply upward right now. And crucially, their consumer money transfer transactions, which is, the core volume of people actively sending money.
The bread and butter.
Right. That turned slightly positive in the quarter for the first time since Q1 of 2025.
Oh, wow. So the actual physical number of transactions is going up again.
Exactly. The underlying engine of the business is firing again.
Okay, so the volume is returning, the revenue decline is aggressively flattening out, and the consumer behavior seems to be trending in the right direction. But the bottom line tells a drastically different story, doesn't it?
It really does. It's a tough read.
Their adjusted earnings per share, so the actual profit they take home per share of stock, it dropped off a cliff.
It did. It came in at 25 cents.
Right, and in the exact same quarter last year.
It was $0.41.
That is a brutal hit to profitability. I mean, going from 41 cents to 25 cents. If revenue is stabilizing and you are physically processing more transactions through the network, why did the profits take such a severe, sudden beating?
That's the million-dollar question.
It kind of begs the question of whether management is just pointing to bad timing to cover up deeper structural cracks in the business model, you know?
And the analysts on the call zeroed in on that exact discrepancy. They were not letting it slide. Matt Cagwin, the chief financial officer, had to methodically walk through the accounting to explain it.
And what was his defense?
Well, he argued against any sort of structural failure. He framed the EPS drop as this highly unusual confluence of timing, seasonality, and accounting mechanics that all just unfortunately collided in the exact same 90-day window.
A perfect storm of bad accounting timing.
Pretty much. But breaking down those specific factors actually offers a phenomenal look at the hidden friction costs of running a massive multinational corporation.
All right, let's tear into that specific friction then. What were the individual factors that dragged the profits down so sharply?
We can start with the foreign exchange or FX loss.
Okay, currency exchange.
Right. Western Union operates across hundreds of countries and utilizes nearly every fiat currency on Earth. They hold massive balances of various currencies just to facilitate daily transfers.
Sure, you need euros in Europe, pesos in Mexico, just to keep the pipes flowing.
Exactly. Now, as global exchange rates constantly fluctuate, corporate treasury departments have to continuously remeasure the value of the cash they hold on their balance sheet against the US dollar.
Because they report their earnings in US dollars.
Yes. And in this specific quarter, the currency markets moved aggressively against their unhedged positions right at the tail end of March.
Ouch.
Yeah. That creates the surprise multi-penny loss that instantly eats into earnings. It's a fundamental reality of global treasury operations, but, you know, it inflicts immediate pain on the quarterly report.
Yeah, the unpredictable nature of global currency markets is a risk you can mitigate, but I guess you can never entirely eliminate it. You are constantly at the mercy of macroeconomic shifts in other countries.
Exactly.
Okay, so FX loss was one. What was the next factor dragging down the bottom line?
The effective tax rate. Their adjusted effective tax rate jumped from 10% in Q1 of last year to 15% this year.
Wait, a 50% jump in the tax rate? Did the tax code suddenly become that much more oppressive overnight?
No, not at all. And that's the tricky part of year-over-year comparisons. In the previous year, they benefited from several one-time discrete tax benefits.
Like what?
Things like resolutions of older tax audits or specific jurisdictional credits that artificially suppressed their rate to 10% for that specific quarter. With those temporary benefits lapsing, they just returned to a normalized 15% rate.
Ah, I see.
So year over year, the comparison looks mathematically terrible, even though the current 15% rate is actually just the standard baseline.
Okay, so bad luck with currency exchange volatility and a tough year-over-year tax comparison that makes a normal quarter look like a massive penalty. But those are purely financial mechanisms. What about the operational side of the business? Was there drag there too?
Definitely. The operational drag came heavily from the timing of vendor incentive payments.
Vendor incentives. What does that mean in this context?
Well, a company of Western Union scale relies on massive third-party vendors for things like enterprise IT services, cloud hosting, global data processing.
Like server space and things like that.
Exactly. And enterprise contracts of that size are incredibly complex. They often feature volume-based incentives or cash rebates.
Oh, like if you process a certain amount of data, you get a kickback.
Precisely. The contract might stipulate that hitting a certain data processing threshold triggers a multi-million-dollar rebate. Last year, the timing of those contract structures meant they booked a massive chunk of those incentives in the first quarter.
Let me guess. This year, the timing was different.
Spot on. This year, the contracts are structured differently, pushing those exact same financial benefits into the second, third, and fourth quarters. So the capital is still secured, they aren't losing the money, but the Q1 ledger just shows a massive vacuum where those rebates used to be.
Is the corporate equivalent of like expecting a massive tax refund in March to balance your household budget, only to be informed the check won't clear until July.
That's a perfect way to put it. Your annualized income remains identical, but your March cash flow looks absolutely disastrous.
Wow. Okay. So FX, taxes, vendor rebates. Was there anything else?
One more big one. The final operational headwind was the severe seasonality of their travel money business.
Travel money. So this is physical cash for tourists.
Right. They recently acquired Eurochange, which is a major player in the UK market that provides physical foreign currency to tourists traveling abroad. Travel money is rapidly approaching a $150 million business segment for them.
That's substantial.
It is. But you have to consider the mechanics of the travel industry. European citizens do not typically take massive, multi-week international holidays in February.
No, of course not. The volume spikes in July and August.
Yeah.
The summer holiday rush.
Exactly. But the infrastructure required to service that summer rush, that's permanent.
Oh. The physical stores.
Right. Eurochange operates physical retail kiosks in major international airports and high-end shopping malls. Those locations demand exorbitant monthly rent. The staff behind the counter require salaries and benefits year-round.
So in the winter.
In the first quarter, Western Union absorbs 100% of the fixed costs of running a premium retail network, but captures only a tiny fraction of the variable transaction revenue. The summer months generate the massive profit margins, but the winter months require absorbing the brutal overhead.
So stacking the FX loss, the normalized tax rate, the delayed enterprise vendor rebates, and the travel money winter slump, it creates a very clear picture of why the EPS missed expectations.
It really does. But, and this is crucial, management didn't just blame external factors. They explicitly admitted to a self-inflicted wound.
Yeah, they used a very specific phrase for it, right?
They called it a dual-track dislocation.
Dual-track dislocation. It sounds very clinical. What does it actually mean?
Well, the dual track is the internal nomenclature for the core tension we established at the beginning of the deep dive. Track 1 involves ruthlessly cutting overhead and optimizing their legacy physical cash operations.
The back book, I think they called it.
Right. And Track 2 involves aggressively deploying capital to build out their future digital initiatives, the crypto platforms, and what they call their beyond architecture.
Okay, so cutting costs on one side, spending heavy on the other. Where does the dislocation come in?
The dislocation occurred because the pacing between those two tracks completely broke down.
They let the spending outpace the saving.
In a very pronounced way, yes. They were aggressively funding massive, expensive digital builds, paying premium salaries for blockchain developers, securing regulatory licenses in new jurisdictions, building out the data architecture. But they failed to cut the legacy costs fast enough to offset that expenditure within the 90-day window of Q1.
So the internal synchronization just failed.
Completely. And that squeezed the margin even further than the external macroeconomic factors already had.
Going back to our analogy from earlier, laying fiber optic cable while riding horseback really holds up here. You are paying top dollar for the fiber optic engineers, but you forgot to sell off the extra horses to fund their salaries, and suddenly you are paying for both entirely out of pocket.
Exactly. Now, management insists this is a strictly temporary pacing issue and that they have, aggressively realigned their cost-cutting measures.
Sure, they have to say that.
But it perfectly illustrates the immense practical difficulty of reinventing a legacy enterprise in real time.
It really does. But this financial squeeze, it wasn't just an internal struggle of accounting and corporate strategy. It was heavily influenced by massive external macroeconomic forces sweeping across their most vital physical market.
Right. The Americas retail business. It's a massive revenue engine for the company. And the CEO, Devon McGranahan, spent a significant portion of the call addressing the severe headwinds that battered this specific region starting in early 2025.
How severe are we talking?
We are talking about steep double-digit declines in the volume of money flowing from the United States down into Latin America.
Double-digit drops.
Yeah.
I mean, to see a decline like that in the world's largest remittance corridor requires a massive catalyst. And the broader U.S. economy wasn't in a free fall in 2025. So what was the specific lever driving that sudden reduction in volume?
Management pointed directly to a volatile cocktail of U.S. immigration policy uncertainty colliding with localized labor market disruptions.
Okay, unpack that for us, because this gets into the psychology of the customer, doesn't it?
It absolutely does. You have to put yourself in the psychological position of a migrant worker in the United States. If you are facing sudden ambiguity regarding your legal status, or you're watching stricter border enforcement policies roll out, or even experiencing an abrupt slowdown in the specific sectors that heavily employ migrant labor.
Like commercial construction, hospitality, agriculture.
Right. If that happens, your financial behavior instantly changes. You stop sending your surplus capital abroad. You hoard physical cash.
Because you need an immediate safety net.
Precisely. You build that safety net right where you are standing because the short-term future has become entirely opaque.
The instinct for self-preservation just overrides everything else. If you fear losing your job or facing deportation, sending your last paycheck 2,000 miles away is arguably the most dangerous thing you can do.
Exactly. So the reduction in remittance volume wasn't a sign that these workers had less desire to support their families. It was a leading indicator of severe economic and political anxiety.
But the data presented on this call strongly suggests that the anxiety is beginning to clear, right?
Yes, the turning point is actually very clear in their internal metrics. If you look at the summer of 2025, which marked the absolute trough of this decline, and compare it to the exit velocity in March of 2026, the revenue growth rates in key Latin American corridors improved by a staggering 800 basis points.
An 800 basis point swing. That is a massive shift in momentum.
It's huge. Take the U.S. to Mexico corridor. That is the undisputed heavyweight champion of global remittances.
The biggest one in the world.
Right. Last year, data from the Mexican Central Bank showed monthly remittance principal plunging by double digits. But by the end of this first quarter of 2026, Western Union saw that massive corridor decelerate its free fall and stabilize. It's now hovering around flat to low single-digit changes.
Going from a severe double-digit bleed to essentially breaking even is a monumental recovery for a corridor of that size. But looking closer at the transcript, this recovery is highly fragmented, isn't it? The entire continent isn't bouncing back in unison.
No, and the divergence in Latin America is a fascinating macroeconomic indicator. Corridors connecting the U.S. to Mexico, Ecuador, and Guatemala are demonstrating this powerful stabilization and improved forward-looking trends.
Okay, so those are recovering.
Right. Conversely, the corridor from the U.S. to Colombia remains mired in significant weakness.
Interesting. So it's very localized.
Highly localized. It's largely dependent on the specific economic conditions and policy realities affecting the migrant populations from those individual nations.
The stabilization in places like Mexico and Guatemala is particularly compelling to me because it doesn't seem to be driven by a sudden miraculous resolution of U.S. immigration policy or a massive boom in the construction sector.
No, nothing like that has happened.
Right. So the primary driver appears to be pure behavioral adaptation. People are finding a new baseline. After enduring a period of extreme disruption and acute fear, the migrant population is adjusting to the new normal, whatever that political or economic normal might be.
They really are. They are returning to consistent sending patterns because fundamentally they have no other choice.
Because remittances are the unbreakable thread of the global economy. I mean, a wire transfer from Texas to Guatemala isn't a discretionary stock purchase or a luxury expenditure. It is a son paying for his mother's insulin. It is a worker ensuring his children have a roof over their heads. Even when labor markets wobble and border policies shift, the absolute human necessity of supporting family forces the capital to find a way to flow.
Yes. You are describing the economic reality that remittances are non-discretionary capital flows. In receiving nations like Guatemala or El Salvador, remittances do not just supplement the economy, they are the foundational bedrock of the gross domestic product.
They are the social safety net.
Completely. They fund basic food security, shelter, and medical care. While you will observe temporary acute pauses during moments of intense geopolitical or economic panic, like the hoarding behavior we discussed, the capital must eventually resume its flow. The underlying survival needs of the receiving family dictate the behavior.
And Western Union understands the inevitable nature of that capital flow better than anyone. And to capture the impending rebound in these vital corridors, they aren't just crossing their fingers and waiting for organic volume to slowly return.
Oh, no. They are weaponizing their balance sheet to actively buy the underlying infrastructure.
Let's talk about that, because the shift in their capital allocation strategy over the past year is profound. For a long time, a mature, highly cash-generative business like Western Union relied heavily on a capital return model, right?
Yes, the classic defensive playbook. They generated massive free cash flow, and they funneled it directly back to their shareholders through aggressive stock buybacks and consistent dividends.
Just giving the money back.
Yeah.
But recently, they have executed a deliberate pivot toward targeted, capability-driven mergers and acquisitions. They are strategically deploying capital to buy technological capabilities and regional market share.
And the geographic spread of these acquisitions is incredibly broad. Last month, they closed on a company called Lana in Mexico. Earlier this month, they finalized the acquisition of Dash, which is a digital wallet platform in Singapore that they purchased from the telecom giant Singtel.
Right. And looking ahead to Q2 of 2026, they're closing on Intermex in the United States, and we already discussed the Eurochange acquisition in the UK.
So analyzing Intermex provides a very clear view of their strategy for pure scale and market dominance.
How so?
Well, Intermex is a formidable player in the U.S. outbound market, particularly deeply entrenched in serving the exact Latin American corridors we were just analyzing. Acquiring Intermex instantly bolts roughly 10,000 new physical retail locations onto Western Union's domestic network.
10,000 locations overnight, that is a massive footprint expansion.
It is. But beyond the footprint, the CEO explicitly highlighted an anticipated $30 million in cost synergies generated by merging the two operational structures.
Which usually means eliminating redundancies, firing people.
Yes. Closing overlapping offices, consolidating management. And he strongly indicated that the realization of those $30 million in savings would be front-loaded, moving much faster than the standard 2-year integration timeline you typically model for an acquisition of this size.
So Intermex is a classic consolidation play, buying physical footprint and eliminating redundant overhead to generate immediate cash flow. But the international acquisitions, Lana in Mexico and Dash in Singapore, those are entirely different beasts.
Completely different.
They aren't buying physical corner stores or cash checking kiosks. They are buying purely digital wallet applications. My question is, why spend millions acquiring local apps when a multinational giant with infinite resources like Western Union could theoretically just build their own native app for the Singaporean market?
That's a great question, and the answer is because the consumer-facing application, the app itself, is actually the least valuable part of the transaction.
Really? Then what are they buying?
When Western Union acquires a company like Dash or Lana, they're targeting 3 specific, highly complex assets: localized regulatory licenses, functional regional tech stacks, and specialized local talent.
Let's start with the regulatory part. Why is that so crucial?
The regulatory aspect is perhaps the most crucial piece of the puzzle. Global digital finance is violently fragmented. There is no universal framework. To operate a digital wallet, you must engage in brutal, multi-year regulatory warfare country by country.
Proving you meet their specific standards.
Exactly. You have to prove you meet hyper-specific localized compliance, cybersecurity, and capital reserve requirements. By acquiring Lana, Western Union instantly purchases the regulatory license to operate a digital financial institution within Mexico. They bypass years of bureaucratic red tape and buy immediate permission to operate.
It is a massive shortcut through the regulatory labyrinth. They acquire the legal right to exist on day one.
Okay, I'll get that.
But you also mentioned the technology stack. The technology stack integration is where the strategy gets truly fascinating.
Dash in Singapore is the perfect case study for their technology strategy. Dash was developed and owned by Singtel, which is a massive telecommunications conglomerate. Singtel succeeded in building a sleek, highly adopted consumer-facing app. People loved using it.
All right.
But their underlying plumbing for actually executing cross-border money movement was notoriously inefficient. They lacked a proprietary global settlement network, so they were forced to rely on a complex patchwork of expensive third-party intermediary banks and correspondent rails to physically move the funds.
So every time a Singtel customer sent money, the capital had to bounce through 3 different intermediary banks, with each middleman extracting a toll, crushing the ultimate profit margin of the transaction.
Precisely. Western Union, conversely, owns and operates the Agent Payout Network, or APN. It remains one of the most ruthless, efficient, and deeply integrated proprietary money movement networks in existence.
So put the two together.
Right. The strategic logic behind the acquisition is brilliant. Purchase Dash to acquire the massive user base and the user interface that Singaporean consumers already trust, but immediately amputate the highly inefficient third-party back-end plumbing. They wire that sleek, localized app directly into Western Union's hyper-efficient, proprietary global APN.
Okay, the theory is flawless. But, I mean, the execution of that specific maneuver is notoriously treacherous. Integrating entirely disparate technology stacks, code bases, written by different engineering teams, utilizing different programming languages, adhering to entirely different cybersecurity protocols across Mexico, Singapore, and the United States, that is traditionally an absolute nightmare.
It is a recipe for disaster in most cases.
The corporate graveyard is full of companies that attempted to bolt acquired software onto legacy mainframes, resulting in bloated code bases, catastrophic system failures, and massive security vulnerabilities. How do they avoid that?
Western Union's management is acutely aware of that danger, largely because they previously struggled with that exact problem. Historically, their piecemeal attempts at integrating acquired platforms in Europe and South America were sluggish and technically fraught.
So what changed?
Their confidence in executing this current wave of acquisitions stems entirely from the development of what they call the Beyond platform. The Beyond platform fundamentally alters their integration architecture. It functions as a newly constructed, highly centralized services layer. Think of it as a universal API gateway and a standardized compliance engine.
So rather than attempting to force the bespoke Mexican code base of Lana to communicate directly with a 30-year-old Western Union legacy mainframe, the Beyond platform acts as an impenetrable middle layer.
Yes, it acts as the ultimate universal translator. The Beyond platform natively houses Western Union's core payment processing logic, their highly calibrated global risk management algorithms, and their universal compliance framework.
All the heavy lifting.
Exactly. When they acquire a local wallet like Dash, they do not attempt a monolithic integration of the entire acquired company. They surgically remove the local back-end settlement layer and plug the front-end user interface directly into the Beyond platform via standardized APIs.
So the consumer in Singapore taps a button on the Dash app they have used for years. The app sends a standardized, encrypted ping to the Beyond platform, and Beyond instantly handles the complex compliance checks, global routing, and final settlement across the APN.
You got it.
It allows them to maintain a hyper-localized, culturally resonant front-end experience for the user while weaponizing a unified, ruthlessly efficient global engine in the background. It is the franchise model applied to global digital finance.
It's a really good way to frame it.
But the true scale of the Beyond platform's ambition isn't just about streamlining the integration of traditional fiat currencies like the peso or the Singapore dollar.
Yeah.
The architecture was explicitly designed to handle the movement of assets that didn't even exist 15 years ago.
Which inevitably leads to their pivot into cryptocurrency and digital assets.
The crypto discussion on this earnings call was genuinely shocking to me. Devon McGranahan, the CEO, made a definitive declaration that Western Union has officially exited the if phase of digital assets.
Right. The internal debate over whether cryptocurrency is a durable technology or a speculative fad is completely over for them.
They are now fully entrenched in the how fast can we scale phase. They are actively deploying a three-pronged digital asset strategy that reads more like the roadmap of a heavily funded Web3 startup than the operational plan of a legacy telegraph company.
The evolution from physical wire transfers to native blockchain integration is profound. The three specific pillars of their strategy are USDPT, the Digital Asset Network, or DAN, and a consumer-facing Visa stable card.
Okay, let's analyze the mechanics of each pillar because it really reveals a deeply sophisticated understanding of how blockchain technology can solve structural inefficiencies in traditional finance. Let's begin with USDPT.
Okay, so USDPT is a US dollar-backed stablecoin. For anyone unfamiliar with the underlying mechanics, a stablecoin is a cryptocurrency specifically engineered to maintain a static value, almost always by being mathematically pegged one-to-one with a fiat currency like the US dollar.
So one USDPT is designed to always equal exactly one US dollar.
Exactly. It strips away the wild, speculative volatility of assets like Bitcoin, providing the stability of traditional fiat while utilizing the speed and transparency of a decentralized blockchain ledger.
But the critical distinction regarding USDPT is its intended use case, right?
Mm-hmm.
Because when USDPT launches next month, it is not designed as a consumer product.
No, not at all. Retail customers will not be downloading an app to purchase USDPT for daily transactions. It is being deployed exclusively as a B2B business-to-business settlement mechanism.
And this is where I have to push back a bit, or at least ask for clarification. Why does a multi-billion-dollar enterprise require a proprietary stablecoin for internal operations? The traditional banking system exists specifically to facilitate corporate settlement. Why bypass it?
Because the traditional correspondent banking system is archaic, heavily fragmented, and incredibly slow. And that friction costs Western Union massive amounts of money.
How so?
To operate their global network, Western Union must constantly settle accounts with thousands of agents worldwide. They are physically moving millions of dollars across borders daily to ensure local kiosks have the necessary liquidity to pay out transfers. To execute these massive internal transfers, they currently rely on the legacy SWIFT network.
The SWIFT network, the foundational plumbing of the global financial system.
Right. And that plumbing operates on a fundamentally constrained schedule. If Western Union initiates a multi-million-dollar transfer from their treasury in Denver to a master agent in Manila late on a Friday afternoon, the SWIFT network essentially shuts down for the weekend.
So the money just sits there.
The transaction enters a holding pattern. It might not officially clear and settle until Tuesday or Wednesday of the following week. In banking terminology, this is T+2 or T+3 settlement, the trade date plus 2 or 3 business days.
So for 2 or 3 days, that capital is trapped in the digital ether between intermediary banks. It is unproductive capital. It cannot be invested, it cannot be used to fund other operations, and if a bank holiday occurs in the receiving jurisdiction, the delay extends even further.
Exactly. Maintaining liquidity across hundreds of countries while battling multi-day settlement delays requires hoarding massive, inefficient reserves of capital just to cushion the delays.
And USDPT solves this.
USDPT fundamentally obliterates that delay. A blockchain ledger does not recognize weekends, time zones, or banking holidays. By circumventing the legacy SWIFT network and utilizing their internal USDPT stablecoin running on a blockchain, Western Union achieves real-time on-chain settlement.
Instantaneous.
They can execute a transfer from Denver to Manila at 3:00 a.m. on a Sunday, and the funds settle instantly with cryptographic finality for fractions of a cent.
Wow.
It instantly eliminates the T+2 delay, unlocking massive reserves of previously trapped working capital and drastically reducing the operational overhead of their global treasury department.
It is an invisible back office upgrade that exponentially accelerates the velocity of their internal capital. That makes total sense. That covers the institutional side of the pivot. The second pillar, the digital asset network, or DAN, is where the blockchain intersects directly with the physical world, right?
The DAN rollout, scheduled for next week, directly targets one of the most persistent bottlenecks in the cryptocurrency ecosystem, the off-ramp problem.
Right.
There are tens of millions of individuals globally holding significant value in digital assets. Bitcoin, Ethereum, various stablecoins within non-custodial digital wallets on their smartphones.
But the inherent flaw in holding a decentralized digital asset is the severe friction of converting it into localized purchasing power. I mean, you cannot easily buy groceries in a rural village with a fraction of an Ethereum token.
No, you can't. Converting digital tokens back into spendable physical fiat cash requires navigating complex, heavily regulated digital exchanges, linking bank accounts, and enduring withdrawal delays.
That's a massive pain.
It is. The digital asset network transforms Western Union's massive, ubiquitous physical retail footprint into the world's largest crypto off-ramp.
How does it work for the user?
Through deep API integrations with major digital wallet providers, a consumer will be able to route their cryptocurrency through the DAN infrastructure and seamlessly walk into a physical Western Union location in nearly any country to instantly withdraw the exact equivalent in local fiat currency.
It bridges the chasm between Web3 and the physical economy. I look at this approach and I see the ultimate financial mullet strategy.
A mullet strategy?
Yeah. You have the highly complex, bleeding-edge Web3 crypto technology operating quietly in the back office, facilitating instant, frictionless global settlement while maintaining the familiar, accessible, traditional fiat cash experience in the front for the everyday retail consumer. Business in the front, Web3 in the back.
Okay, I see it.
The grandmother walking into a kiosk in El Salvador to pick up her remittance doesn't need to understand cryptographic hashing or blockchain ledgers. The complexity of the technology is entirely abstracted away. She simply receives her physical cash, exactly as she has for decades, but the delivery mechanism behind the counter has been completely revolutionized.
The mullet analogy is surprisingly accurate in describing the bifurcation of the user experience. The technology remains entirely invisible to the end user.
Okay, so that's 2 pillars. What about the third?
The final pillar of the strategy, the Visa stable card, represents the natural evolution of that concept, pushing the digital asset directly into the consumer's hand.
The Visa stable card, slated for launch later this year, is a fascinating product.
It is specifically engineered for consumers residing in heavily inflation-sensitive markets economies, where the local government-issued currency is rapidly depreciating, destroying the purchasing power of the citizen's savings.
Places experiencing hyperinflation.
Right. The stable card allows these consumers to convert their savings into a dollar-backed stablecoin, effectively holding their wealth in digital US dollars shielded from local hyperinflation.
But how do they spend it?
Crucially, rather than requiring them to visit a Western Union location to cash out, the stablecoin balance is directly linked to a physical Visa card. They can spend their digital dollars globally, instantaneously, at any merchant that accepts the Visa network.
Western Union is essentially positioning itself as a shadow neobank for the unbanked and the underbanked in highly volatile emerging markets. They are providing both the stable reserve asset and the frictionless global payment rail.
When you combine USDPT for institutional settlement, the DAN network for physical off-ramping, And the Visa stable card for direct consumer spending, Western Union is attempting to construct a massive closed-loop digital asset ecosystem under their exclusive control.
The ambition is staggering. But, let's be real, the reality check is severe. Architecting a bespoke digital asset ecosystem, navigating the regulatory approval process across dozens of sovereign nations, deploying the Beyond platform, and simultaneously digesting the acquisition of Intermex and its 10,000 retail locations. It requires an oceanic amount of capital.
Yes, it does.
And as the Q1 earnings report brutally highlighted, their profit margins are currently under extreme pressure. To finance this aggressive sprint into the digital future, the legacy operations must be subjected to a ruthless, unforgiving diet.
The financial reality forces their hand, bringing us directly to their accelerated operational efficiency program. In direct response to the sluggish Q1 margins and the sheer capital requirements of the digital build-out, management announced a massive acceleration of their cost-cutting initiatives.
How massive?
Initially, the goal was to carve out $150 million in operational savings by the end of 2028. They have violently pulled that timeline forward, restructuring the organization to realize the vast majority of those savings in 2026 and 2027.
Shaving years off the deadline. Extracting $150 million from a legacy enterprise on that compressed timeline requires deep structural surgery.
It does. And the CEO outlined 3 specific pillars for this massive cost-cutting initiative, and none of them involve subtle adjustments.
Walk us through them. What's the first pillar?
The first pillar focuses heavily on regionalizing operations to decimate corporate overhead.
Meaning moving jobs out of expensive cities.
Exactly. Historically, massive multinational corporations trend toward deep centralization, establishing bloated corporate headquarters, often in highly expensive U.S. markets that dictate operations globally. The new efficiency model shatters that centralization, heavily empowering regional hubs.
So where are they moving?
Management explicitly highlighted Manila as the new primary operating center for the entire Asia-Pacific or APAC region. By migrating the operational center of gravity closer to the actual local markets and fundamentally shifting the labor force to regions with significantly more favorable economic dynamics, they instantly slash massive amounts of centralized corporate bloat.
Decentralize the management structure and arbitrage the global labor market. Makes sense from a spreadsheet perspective. What is the second pillar?
The second pillar involves the aggressive sunsetting of legacy technology platforms.
This ties directly back to the Beyond platform, right?
Yes. As Western Union successfully migrates a larger percentage of their global payment processing, compliance checking, and risk management onto the Beyond architecture, the massive, antiquated legacy mainframes become redundant. They are aggressively porting their massive data infrastructure entirely into the cloud, specifically partnering with Snowflake.
And the financial benefit there is just turning off the old servers.
The financial mechanics of this shift are profound. Once the global data architecture is fully operational in the cloud, utilizing modern, scalable compute, the company can physically unplug the localized servers. They instantly eliminate the massive licensing fees associated with legacy software and drastically reduce the army of highly specialized IT staff required simply to keep 30-year-old code bases functioning.
You stop paying to maintain the decaying plumbing. Okay, the third pillar of the diet is the one that dominates every corporate earnings call right now. But Western Union is applying it in a highly consequential way, the deployment of artificial intelligence.
They are entirely bypassing the theoretical hype and deploying specific, highly utilitarian AI models across their service operations, software development, and marketing departments.
Let's look at the mechanics of how AI actually generates measurable cost savings here. In service operations, the application is incredibly direct, isn't it?
The sheer volume of daily customer support interactions a company like Western Union handles is astronomical. A massive percentage of those inquiries are highly routine and transactional. Users tracking the status of a transfer, requesting current foreign exchange rates, or navigating simple account recovery processes.
Simple questions that don't need human empathy.
Exactly. By deploying highly advanced natural language AI models, specifically large language models integrated directly into their backend databases, they can autonomously intercept and resolve a massive percentage of these interactions without ever routing the customer to a human agent.
So the AI just handles it.
The AI instantly queries the system, delivers the precise information, and resolves the friction point in seconds. drastically reducing the demand on the human call centers.
And within the tech development sector, they're utilizing AI coding assistants. Software engineers are leveraging AI to draft boilerplate code, autonomously debug complex errors, and instantly generate routine testing protocols.
It speeds everything up.
Yeah, the AI functions as a massive force multiplier for the engineering department. The existing developers can increase their output exponentially, meaning the company can execute complex platform builds with a significantly smaller engineering footprint.
Which forces the uncomfortable conversation regarding human capital. If AI allows the company to execute more work with fewer people, and the mandate is to cut $150 million in overhead, the logical assumption is a wave of massive corporate layoffs.
But the CEO addressed the human cost directly, didn't he? Detailing a strategy that supposedly avoids the catastrophic morale hit of mass firings.
He did.
In an enterprise organization of this scale, natural employee attrition is a constant baseline. Employees regularly retire, transition to competitors, or shift career paths entirely. Historically, when a mid-level manager or a customer service representative departs, the human resources department must immediately deploy capital to recruit, interview, hire, and extensively train a replacement.
The standard backfill process.
Right. The CEO explicitly stated that the deployment of these AI tools allows the company to simply absorb that natural attrition without triggering the backfill process. When an employee leaves, the AI assumes the workload, and the position is permanently eliminated from the payroll.
It is a quieter, less disruptive mechanism for shrinking the total workforce, but mathematically highly effective for achieving the $150 million target.
I have to pause and look at the aggregate picture being painted here because the execution risk is genuinely terrifying to me.
It is a lot all at once.
Management is systematically gutting the legacy back office to extract $150 million. They are aggressively shutting down the foundational IT systems that have processed their payments for decades. They are heavily relying on newly implemented AI models to manage global customer service and write critical software code. And they're attempting this massive internal surgery while simultaneously launching a native institutional stablecoin, opening their global physical network to decentralized digital asset wallets, and trying to smoothly absorb 10,000 new retail locations and thousands of employees from the Intermex acquisition.
Yeah, when you list it all out.
It looks like juggling flaming chainsaws while riding a unicycle on a tightrope. A single critical failure in the Beyond integration, or a massive regulatory block on the crypto rollout, and the entire Highwire Act collapses.
The skepticism is highly warranted, and the market clearly shares your concern. We established that the Q1 dual-track margin dislocation was caused precisely because they stumbled while attempting this exact balancing act.
Right. So why should we believe they can pull it off?
The counterargument and the thesis management is aggressively selling to Wall Street is that executing complex operational diets is a deeply ingrained known muscle for this executive team.
They have the organizational scars to prove they can do it.
Exactly. This specific management team recently successfully executed a prior $150 million cost reduction program, cleanly extracting the capital while simultaneously building the foundational architecture of the Beyond platform. They have a proven track record of maintaining operational stability while shrinking overhead.
Past performance is an indicator of future success.
Right. But more importantly, the execution risk is completely unavoidable. The alternative is terminal decline.
Adapt or die.
If they fail to ruthlessly extract that $150 million from the legacy business, they lose the capital required to fund the digital expansion. If the digital expansion stalls, they will be methodically bled dry by the younger, highly agile fintech competitors circling their market share.
The chainsaws are dangerous, but dropping them means surrendering the market entirely. And the absolute necessity of this ruthless efficiency program becomes glaringly apparent when you analyze the fundamental paradox buried in their current digital growth metrics.
The digital paradox, yes.
The digital business is expanding rapidly, but it is not replacing the legacy cash flow on a one-to-one basis.
That paradox is the most critical metric for understanding their long-term valuation. In the first quarter, Western Union's branded digital business experienced a massive 21% surge in total transactions.
21% is massive growth.
Consumers are aggressively migrating to their digital platforms. However, the revenue generated from that digital segment only increased by 6%.
The network processes 21% more volume, but only captures 6% more top-line revenue. The spread between those two numbers is massive. What is driving that severe compression in revenue yield?
The compression is driven by three specific structural shifts in their business model. First, the 21% transaction growth is heavily concentrated in low RPT revenue per transaction corridors.
Give me an example.
Management explicitly highlighted a massive surge in volume moving from the Middle East into India. This is an incredibly dense, highly competitive remittance corridor. To capture volume in that specific market, the fee charged per transaction is intensely compressed. You generate massive transactional volume, but the aggregate revenue scales at a fraction of the pace.
So the volume is there, but the margin is razor thin because they have to cut fees to compete. What is the second structural shift?
A profound evolution in consumer delivery preferences. Account-to-account payouts surged by an astonishing 45% during the quarter.
Gaining.
This means the sender utilizes the digital application to route the funds directly into the bank account of the receiver.
So the transaction entirely bypasses the physical retail location. The receiver never walks into a kiosk to pick up cash.
And that fundamentally alters the profitability of the transaction. Historically, the physical cash pickup represents a premium service. Western Union charges a higher fee for the complex logistics, physical security, and sheer convenience of maintaining a physical vault of local currency in a rural village. When the capital moves strictly digitally, from one bank account to another, that premium evaporates, leaving a significantly thinner margin.
And the third factor driving the revenue gap.
Aggressive customer acquisition costs disguised as promotional pricing. To fuel that 21% surge in digital transactions and capture market share from aggressive fintech startups, Western Union has heavily utilized steep fee discounts and zero-fee promotional periods.
So they are essentially buying the user base, willfully suppressing their own short-term revenue to lock consumers into their digital ecosystem.
Exactly. They are pushing the digital expansion flawlessly, but the math dictates they make less money per digital transaction. Yet, despite this massive digital push, they are simultaneously scoring massive, highly lucrative victories on the physical retail side of the business.
The physical retail network refuses to die. In fact, it is evolving. Amidst the digital push, they announced a massive exclusive retail partnership with the grocery behemoth Kroger in the United States, alongside extensive rollouts within the Deutsche Post in Germany and the Canada Post system.
Which is huge for their physical footprint.
Right. Management projects these specific new retail integrations will generate roughly $100 million in newly added revenue once fully operational. But looking at these dual strategies side by side raises an immediate question. Are they actively cannibalizing their own highly profitable legacy business?
It looks like it, doesn't it?
Why would you spend millions developing an app and offering zero-fee promotions to convince a consumer to send money digitally when you could theoretically force that same consumer to walk into a Kroger, utilize the physical network, and pay a significantly higher premium fee?
Because it is the purest distillation of the innovator's dilemma. If Western Union stubbornly protects their high-margin physical business and refuses to offer the frictionless, low-cost digital payout, a nimble fintech competitor like Revolut or Wise will instantly provide it.
Someone else will take the money.
You have to aggressively cannibalize your own legacy margins to protect your overarching market share. You must disrupt your own business model before a competitor renders it obsolete.
Your own lunch before someone else eats it for you.
And the execution of these specific postal and grocery contracts is a masterclass in defensive strategy. Western Union recognizes that a significant demographic globally will always require physical cash. By securing exclusive integrations with the German and Canadian postal systems and the vast Kroger network, they guarantee a ubiquitous, unavoidable physical presence.
But without the traditional overhead.
Right. Crucially, instead of Western Union deploying capital to lease real estate, build kiosks, and hire dedicated tellers, they leveraged the Canadian government and the Kroger Corporation to absorb the entirety of the physical overhead.
Wow.
They successfully maintained their critical cash payout network, effectively subsidizing the massive operational costs through third-party retail partners, freeing up their internal capital to relentlessly fund the digital expansion.
It is a brilliantly constructed dual strategy. But we cannot analyze these global networks, the shifting consumer demographics in the Middle East growth corridors without confronting the immediate geopolitical reality. The Middle East was highlighted as a massive growth driver for their digital volume, but the region is currently engulfed in severe, escalating conflict. How did the executive team address the impact of a hot war on their operational metrics?
Management approached the geopolitical situation with a highly clinical, data-driven perspective, noting that severe regional conflicts historically exert a contradictory dual impact on a global remittance network.
Explain the contradiction. How does the conflict impact the broader business?
The initial immediate impact is the devastation of adjacent business lines. For instance, their newly acquired UK travel money business, Eurochange, experienced a sudden, sharp decline in volume.
Because of the conflict.
The underlying mechanism is obvious. European tourists immediately cancel planned vacations to destinations like Dubai or the broader Middle East the moment regional instability dominates the news cycle. The fear of escalating conflict instantly paralyzes the tourism sector.
So the travel money dries up overnight. But what happens to the core business of remittances flowing out of the conflict zone?
That is where the data reveals the contradiction. In the initial phases of a severe geopolitical crisis, sheer panic actually drives transaction volume violently upward.
Well, yeah.
Upward. Individuals residing within or adjacent to the conflict zone rush to liquidate local assets and move their capital to perceived safety. They aggressively send their savings out of the region, routing it to family members in Europe or Asia. Consequently, Western Union observed a moderate but distinct acceleration of outbound remittance volume from the Middle East, directly correlated to the onset of the conflict.
The fear of losing everything drives a massive, immediate spike in capital flight. But that surge is entirely reactionary. It is finite.
And management provided a stark warning regarding that exact limitation. They emphasized that while panic drives initial volume, if a conflict devolves into a prolonged, entrenched war, it eventually asphyxiates the regional economy. Foreign migration into the region halts, vital infrastructure is decimated, and broad economic opportunity evaporates.
And the money stops flowing.
Eventually, the outbound volume of remittances will inevitably collapse, simply because the affected population has exhausted their capital reserves. They are monitoring the situation with intense scrutiny, recognizing that a protracted conflict will ultimately devastate one of their most vital digital growth markets.
It is a sobering reminder that a company like Western Union does not exist in a sterile spreadsheet or a vacuum of corporate strategy. Their network is deeply embedded in the messy, violent, unpredictable reality of global human events. The volume of capital moving through their servers is ultimately just a digital reflection of human panic, resilience, and the fundamental drive for survival.
That is precisely the lens through which this entire earnings call must be viewed.
We have covered a massive expanse of territory today. We started by dissecting an EPS miss triggered by a perfect storm of treasury mechanics, tax normalizations, and a dual-track dislocation. We explored the macroeconomic stabilization of the vital U.S. to Latin America corridors, analyzing how migrant populations adapt their financial behavior to shifting political realities.
We analyzed their aggressive pivot into capability-driven M&A, detailing how the Beyond Platforms architecture allows them to acquire localized digital wallets and wire them directly into the highly efficient global plumbing of the agent payout network.
We broke down the crypto pivot, the financial mullet strategy, utilizing the USDPT stablecoin, to entirely bypass the friction of the legacy SWIFT banking system, and deploying the DAN network to seamlessly convert digital assets back into physical fiat cash.
We examined the extreme measures of their $150 million efficiency program, utilizing cloud architecture and advanced AI language models to shrink the workforce through natural attrition.
And we navigated the fundamental paradox of cannibalizing their highly profitable physical cash business to aggressively expand a lower-margin digital footprint, all while managing the volatile shockwaves of the Middle East conflict. It is, without a doubt, a corporate high-wire act of unprecedented scale. Western Union is relying on the absolute, unshakable human necessity of sending money home to finance a radical, incredibly painful metamorphosis from a legacy physical cash network into an AI-automated, blockchain-integrated global digital powerhouse.
If they successfully execute the integration of these disparate technologies while maintaining their legacy cash flow, it will be studied as one of the most remarkable corporate reinventions of the modern era.
Before we wrap up this deep dive, I want to leave you, the listener, with a final provocative thought. A concept to mull over that builds on the fundamental architecture we've just dissected. We spent significant time exploring USDPT, Western Union's proprietary US dollar-backed stablecoin. We detailed the exact mechanics of how they intend to utilize this blockchain asset to bypass the archaic SWIFT banking system, allowing them to execute multi-million-dollar institutional settlements instantly across borders, completely ignoring weekends and banking holidays, thereby freeing up massive reserves of trapped capital. If Western Union successfully executes this strategy at scale, if they definitively prove to the market that a massive multinational corporation can seamlessly, legally, and securely utilize a proprietary stablecoin to circumvent the immense friction, the multi-day delays, and the rent-seeking fees of the traditional correspondent banking system, what is to stop every other massive multinational conglomerate on Earth from executing the exact same maneuver? Imagine Apple needing to instantaneously settle accounts with thousands of component suppliers across Taiwan and Vietnam.
Imagine Toyota moving billions in capital daily between manufacturing hubs in Japan, Mexico, and the United States. Imagine Amazon executing frictionless real-time payouts to millions of third-party merchants globally. If Western Union proves the blockchain model is viable for enterprise settlement, why would any of those corporate titans continue to tolerate the T+2 delays and the exorbitant fees extracted by legacy commercial banks? Are we watching Western Union simply upgrade the internal plumbing of their own network, or are they inadvertently prototyping the complete obsolescence and death of the traditional corporate banking rail? Something to think about. Until next time, keep diving deep.